Welcome to Callum Teaches Forex. Today is Monday, the 2nd of December, 2019. This will be the first video and it has been inspired by a friend. As you can see, I made a folder just for him. Now, what is Forex? Forex is the foreign exchange market. This is where currencies are traded. Let's give it a search. Forex. Oh, my bad. What is Forex? When it says here in Wikipedia, the foreign exchange market is a global, decentralized, or over-the-counter market for the trading of currencies. This market determines foreign exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at current or determined prices. And so that basically means that we have buyers and sellers in this market that determine the exchange rates of different currency pairs. You have all sorts of currency pairs. We have Euro USD, the Australian dollar versus the Canadian dollar, the US dollar versus the Japanese yen, etc. In this tutorial, specifically, we're going to be talking about candles and price action. Candlesticks, sorry. Now, I prepared an image already, and this image shows the fundamentals of the candlesticks. As you can see, we have a closing price. Oh, it's a bit too big, my bad. Right, we have a closing price, as this is buy. So green represents buy. Sorry about that. Green represents buy. This is your opening price. What does this mean? This means in the market, the buyers, this is where the price opens, this is where the price closes. It depends on the time frame. So in 1 minute, one candlestick is made. That's the 1 minute time frame. You have 15-minute time frame, so every 15 minutes, one candlestick is produced, or every hour, every day, every week, every year. You get the picture of it. In this bullish market, as it says over here, the opening price is the price at which this first candlestick is opened at. Buyers aggregate and they send the currency up, and when the market has closed, which is after that minute has elapsed, after 15 minutes has elapsed, this is the closing price up here. My bad. This is the closing price. This is what you call the body of the candlestick, because it is the main part of this candlestick. Now, as you can see, we have some different parts over here. We have this high price and this low price. Well, let me correct that. High price and low price. Essentially, what it is, when the market opens here, sellers push the market down, but the buyers said nope, and they push the market up. Now this high price is when this market goes all the way up over here, and sellers say no. The market, this is not going to be the price of this certain exchange rate. We want to push it down. So they invest and they sell and push it down, and it reaches this closing price. This is where the market eventually closes. So this low price just says that at one point in time, the current price of this exchange rate was here, and at one point in time it was up here, but the market opened over here, and this is where the market closed off, at this closing price over here. So 3 things to note when it comes to buying, or the buyers in the market. The opening price is always below the closing price. I repeat, the opening price is always below the closing price. Same thing applies to sellers. However, they're selling, so the currency or the value of the exchange rate is decreasing. Here's how it happens. This is where the currency, or where the current price opens at. It goes down, and this is where the market closes. Same concept for high price and low price, but it's a bit different, because where this high price is, where this high price is and where this low price is, tells a bit of a different story from the buyers. What it says is, this is where the market opened. The buyers, on the other hand, pushed the price up. This is the highest price it's been at, and the sellers said nope, they pushed the price down. It's the lowest price it's been at. The buyers then said no, and they kept pushing and pushing for the price to rise. And after this minute has elapsed, or the 15 minutes has elapsed, or the hour has elapsed, this is where the market closes. I'll explain one more time. In a nutshell, this is where the market opened. Buyers rushed in, elevated the price to this highest price, but then sellers said no. They put the price, or kept selling and selling and selling till it got to this lowest price. After it got to this lowest price, the buyers said nope, and they kept pushing and pushing and pushing, and the market eventually closed off at this section over here. So a few things to note would be, when it comes to buyers and sellers, I'll put buyers over here. My bad. When it comes to buyers over here and sell, my bad. When it comes to buy and sell, the buying is the opening price, is the closing price. The closing price is always above the opening price. So once the price opens and buyers aggregate the market, once the closing price is above the opening price, is what you call a bullish candlestick. It's opposite for the bearish candlestick. Once the market opens and the price is open and the closing price is below, the closing price is below the opening price, it's called a bearish candlestick. That means the market has been aggregated by bearish investors, bearish traders. So this is buy, which means you're going up. This is sell, means you're going down. This is just the basic theory. We're going to get into some practical as of now. So I have open. No. Right, so, okay. I have open at the moment the US dollar versus the Japanese yen chart. My bad. US dollar versus Japanese yen. And I would like to zoom in on this area over here. What will be the most common place? Right, so we have this, which is a bullish candlestick, and a bearish candlestick. What I would have meant was the market opened at, the market opened at this specific price over here. The buyers aggregated the market, pushed the price up, and it closed at this price over here. Same thing for the bearish candlestick.